Stock is not the company, and the company is not the stock.
It's only in moments of extreme volatility that you quickly realize whether you were speculating or investing into your favorite companies, because investors know exactly what to do when their favorite assets drop in value. And as Bezos said, you shouldn't always correlate the stock price to the underlying business. And on that note, I went ahead and picked up some of my favorite stocks this morning. I bought some more Tesla shares. We'll be discussing that. More importantly, we're going to be talking about Google and Facebook earnings coming out. Google tonight, Facebook tomorrow, with a lot of YouTubers complaining about ad rates dropping. I'm going to give you some pure insights into my own personal ad rates on YouTube and what I think is going to happen with these earnings. We're going to be talking briefly about oil. We're going to be diving into some of my favorite real estate investment trusts, because we got some earnings coming out on stocks that I even bought at the beginning of this year. Many of you know, like Medical Properties Trust. If this is a conversation that interests you, I ask in return that all you do is hit that like button, because we are living in one of the most fascinating markets, and it never ceases to amaze me here, folks. So first and foremost, let's dive into this market, because like I said, guys, do not expect the volatility to dry up. I'm not expecting all-time highs out of this market, and I'm hoping we see further downside. I don't like when stocks go up. I don't know why investors keep thinking that green is great when you're going to be cost averaging into this market for the next 5 or 10 years. It'd be like walking into a Rolls-Royce dealership and them saying, hey, would you rather pay 30% off or pay the 30% premium? Honestly, I'd rather buy the 30% dip. So getting into this, folks, let's talk about Google and Facebook, and are they going to continue dipping into the earnings this evening? Because Facebook is already trading down massively from its all-time highs here. Well, it hit a low of like 25% from the highs, and same with Google here, not as much, but it did pull back, and we're starting to see a bit of a rally today, which we'll see what happens when earnings post, whether it goes up or down. But what I want to talk primarily about is my YouTube income here, guys, the holy grail of the world, making money at home. And no, I don't make a lot of money off YouTube. I told you this, guys, over and over again. I don't make any money off this. I've been around since 2018, and I've only made $15,000 off my YouTube channel from ad rates. I don't rely on this. You divide that out, it's an absolute terrible income for the amount of videos that I post. But what you need to pay attention to is the CPM, the cost per milli, as they call it, which just represents how much advertisers are paying in the finance space, for me particularly, per 1,000 views. And right now they're paying about $21.49. And you can see coming into the beginning of the year here, guys, it has dropped off rapidly. And this is what all these YouTubers are complaining about. And the funny thing is if you go back through the history of your CPM, it's almost like a cyclical complaining thing that happens with these YouTubers, because no offense, at the beginning of every freaking year, advertiser dollars dry up, folks. The holiday seasons have surpassed us. It's a bit of an off period because people aren't spending as much money promoting products, and that's happened at the beginning of every year. In fact, ad rates historically drop down to these lows at the beginning of January, February, and March. But the intriguing thing with Google, guys, is what I can tell you is that they were actually hitting all-time highs and more consistent highs in the CPM going over the holiday season. So I think this is going to bode excessively well for the Q4 results. And the other thing that we were kind of talking about too is the YouTube saturation of the market. If the YouTube saturation continues to expand out, does that just mean there's less advertising dollars for people like myself and other YouTubers, because they have to expand those dollars into other YouTubers as well? That's another thing you could discuss. Now, keep in mind, the CPM, I only get 50% of that. So it's called RPM. That's my actual payout per 1,000 views. So you got to remember, Google takes a 50% cut. Don't feel bad for me, though. That's why I get sponsors on this channel, to make sure that I can keep delivering this content with ease. Now, putting that aside, folks, let's talk about Tesla a little bit, and maybe some of the oil earnings, because we did get Exxon this morning, and it's trading up a whopping 6% here. Look at that big jump, man. Congrats to anybody that had the guts to get into oil at the bottoms, because it has outperformed the market drastically. I mean, Exxon is trading up a whopping 80% here, guys. We got a little ways to go before all-time highs, and I'm curious to see if we can get back there with just the general demand of the earnings, because we know that a lot of big pension funds and hedge funds will not buy into these because they don't check off that list of carbon emission targets. It's a big problem with Bitcoin that obviously Kevin O'Leary's pointed out a lot of times, but still, my goodness gracious, what a rally, as oil rallies as well, continuing to push those margins up. I mean, oil sitting at 8-year highs right now. So very, very intriguing stuff. But where my interest lies is in Tesla. Now, the reason that I'm going to be talking about Tesla is because we have GM earnings coming out tonight. And I'm not going to try and expand on this because Cathie Wood, and I know she's a controversial topic here, but she pointed out some interesting facts that I've kind of come to my own conclusion on that led me to be buying buying more Tesla shares this morning. I picked up one more share at about 9.23. I wish I caught those major dips that we've been seeing. And again, guys, Tesla could drop to 300. I don't know what it's going to do. Don't buy into this because I'm buying into this. This is just my own personal interest, so take that with a grain of salt. But I now have 23 shares of Tesla. My average buy is still well under $700, even cost averaging in at these higher prices. But more intriguingly, guys, I'm going to let Cathie Wood kind of summarize up how I've generally been feeling, because she kind of hit on a lot of major points, which is why you need to pay attention to Ford, GM, Toyota, and all these other OEM manufacturers. So just take a quick listen and we'll be right back.
At an annual rate here in the United States, new auto sales peaked in April at 18.25 million units. Now, when we got to October and the auto OEMs were talking on earnings reports, each one of them, including Elon Musk, was saying, okay, the chip shortage is beginning to alleviate. Now, they had been blaming the decline in sales because it started in April and it was declined to 13 million units from 18 and a quarter. That 13 is an October number. Chips were the missing link. Okay, they're starting to be replenished. November, 12.86. December, we just got this number, 12.44. Meanwhile, you've got electric vehicle sales up nearly 100% at an annual rate. What's going on here? Well, it could be a combination of consumer sentiment not being happy about what's going on, and a consumer preference shift towards electric vehicles. That is why at the CES show, the Consumer Electronics Show, you heard these auto OEMs talking more about electric vehicles. Of course, it was the electronics show. And we saw that Ford's F-150 Lightning, that they were going to have to double production given all of the demand. Well, what they don't tell you during those appearances at CES and so forth is that electric vehicles make up maybe 2 to 3% of their sales, and that 97% of their revenue bases are gas-powered vehicles. And it's probably 90% plus of their production now. If there is the combination of the consumer turning off, not wanting to spend as much money, certainly not on big ticket items, and a preference shift, if they're going to spend, they're going to spend on electric, then these OEMs have an issue. I look at the performance of stocks like GM and Ford. They soared on those electric vehicle announcements. Think about that. That's ridiculous. It's only 2% of their sales. And what if the other 98% or so forth are on their way out as the consumer preference shifts toward electric? They have problems. They have problems because their gross margins, depending on the company, are somewhere between 10 and 20%. Those are very low gross margins. And if you look at the Bloomberg estimates for this year, 2022, after a very weak 2021, you see growth estimates in the 10, 15, 20% range. The US-based ones are at the higher end of that. Well, that may not happen. And again, they don't have a lot of room for error. And we have seen them pivoting and announcing that they're pivoting ever more quickly towards electric. But the problem is almost 100% of their base is going to go obsolete over time.
So look, guys, I think it's really intriguing because we're going through this massive shift right now, and I think this is by far the worst time in history to be buying an internal combustion engine brand new. If you're expecting to go out and buy a $30,000 or $40,000 regular car, I think it's going to be dumb, because I think it's going to degrade in value faster than perhaps we've seen it in the past, because in the next 3 to 5 years, the shift in consumer demand to EVs aren't going to give you a lot of used value in the traditional combustion engine. And the crazy thing is because Tesla's at this critical S-curve phase where it's just skyrocketing and really just expanding their demand in their factories, guys. It's boding very well as they continue to keep in the forefront of that consumer demand, whereas GM, Ford, all these companies aren't ramping up to really decent EV production until about 2026 timeframe. And considering they're about to lose out on their entire OEM lineup, or their internal combustion, those ICE vehicle lineups, guys, it's going to be very bad for them. I think that they're kind of at this critical phase where they're either going to make this work or we're going to see a massive decline in their revenues. And this is all the stuff that's kind of controversial in topics, but GM has been losing global market share. A lot of these companies like Ford have generally been losing global market share consistently year over year to China. Toyota has really taken storm, and along with those other Chinese EV makers, or not EV, but just generally the China automakers. So I always recommend that you start paying attention to what's happening now, because the next 3 years are going to be the most pivotal, and why I can't help but continue to be bullish on Tesla and continue to pick up shares. Now, that's just a personal opinion. You can always let me know what you think in that comment section below. But putting the EV discussion aside and my Tesla shares here, guys, which consider subscribing for Friday, because I'm going to show you how all of these kind of relate in my portfolio at scale and percentage weightings. But another big earnings coming up that I'm going to be closely paying attention to are some of these dividend companies, guys. I mean, we've got Waste Management posting also on Wednesday. We've got MPW, which is my favorite company, one of my favorite real estate investment trusts of all time, Clorox, Amazon. This is going to be a really fun few days in my opinion. But if I were you guys, and again, not financial advice, I would perhaps, buy some Medical Properties Trust, man. I absolutely love this REIT. It almost cracked all-time highs. Again, this isn't a company that's just skyrocketing with growth, but you're getting a 4.9% starting yield here. And this is a company that's increased their dividends year over year, which is another reason I absolutely love them. It's hard finding REITs that can do that have such a higher starting yield as well. But this is a company that just leases out, triple net leases out, by the way, hospitals globally, with most of their hospitals being in the US. And the triple net lease structure, and most of them are locked in for 10, 15 years, which is incredible, by the way, which basically just means that the clients that own the hospitals have to deal with the maintenance, the repairs, and they have to pay out to us, the shareholders. So there's no real maintenance involved or capital cost up front from the company side, which is just amazing, by the way. And again, hospitals, staples to society here, guys. And on top of that, their lease structures have inflation baked into it. Now, keep in mind, inflation's out of control, but luckily they have an inflation rate baked in of 2%. So every year they can increase the rents by 2% in those locked-in leases, which also is what offers such stability in the dividend growth. So I'm really going to be looking forward to those earnings as well, something that I would be paying a lot of attention to. And these are just some of my favorite companies, guys. I mean, there's so much interesting conversations going on across the whole spectrum here. Obviously, Tesla continues to ignite my love. Like I said, guys, when my favorite large cap companies start selling off, I want my large conviction trades to be about 8 to 10% in my portfolio. So when they drop off, it gives me an opportunity to continue to add into them, because I told you when they get over 10%, I start speculating that it's time for me to maybe just start trimming them. But when they drop, it's kind of time to continue to add to them, guys. So I'm still, going to keep cost averaging into this market. I bought more MPW at the beginning of this year. I'm still buying into some of those, obviously some of my bank stocks, which unfortunately the Canadian banks aren't posting earnings for another few weeks, I believe, as they post later into February. Lots to look forward to, and I'm going to continue to update these stories. So if that's something that interests you, consider hitting that subscribe button. Support the channel, guys, because like I said, I basically am just doing this for free outside of my sponsored videos, and I'm trying to pick the best sponsors I can find. I'm really weaning through them now that I've kind of got some foundation, some respect, some decent content out there. I've really kind of driven in some really good sponsored videos. But stay cool, stay awesome, and I look forward to catching you in the next one.